Welcome back. You're watching Editors Roundtable on CNBC-TV18. And let's put the spotlight on the tech names. They'll be first to come out with their Q4 numbers starting early April. Now, Q4 is likely to be a very muted quarter for the IT companies. Discretionary spending has still not come back. So these are the numbers that UBS is anticipating. As you can see, it will be flat to negative constant currency revenue growth on a quarter-on-quarter basis for the large cap IT names. The FY26 revenue guidance, which Infy and HCL Tech give, is also likely to be very conservative. So according to CLSA, Infy is likely to guide for 2 to 5%, while HCL Tech will be about 3 to 5%. They want to just put in some amount of buffer given the macro uncertainty. That said, UBS still expects FY26 to be better than FY25, even though discretionary spending has been delayed, the recovery in discretionary spending. So these are the numbers. As you can see, for FY26, the street is now expecting low to mid-single digit kind of a top-line growth, which will be marginally better than what the companies did in FY25, barring TCS, because TCS in FY25 had the boost of the BSNL deal. You know, the big thesis that's played out over the narrative over the last 2 months in IT is the discretionary spending, which was expected to, get revived and boost growth in FY26, that is getting delayed. But, UBS says that, we chatted with a lot of managements of IT companies, and although the macro uncertainty, the noise has increased, it's not that tech budgets have been materially impacted. So that's a positive. CLSA too says that the near-term all the pessimism is priced in, and the near-term consensus cuts seen in the IT stock is already being factored in. They remain positive on IT, even if there are tariffs or no tariffs. In the event of tariffs, they're saying we will see more cost optimization deals because clients would be hard-pressed. There will be more cost optimization deals. And if there are no tariffs, then there will be a faster recovery in discretionary demand. So CLSA's call is, if there are tariffs, there are no tariffs, IT is likely to do well. Now, year-to-date, IT companies have had a rough start. They've recovered, from the lows, but they're still down about 10 to 15% on a year-to-date basis. So does that make them attractive? Just want to put the risks on board that US could slow down materially. Right now, discretionary spending on a sporadic basis have been impacted in sectors like retail, for instance, manufacturing, where there is a lot of fear on the back of tariffs. But if it becomes more broad-based, then will it start hurting the IT sector? Let's ask Sandeep on tech. Sandeep, you've already said that tech is not a favored sector for you. Your exposure on tech is practically